This video is about long-term contracts that are they last more than a year or more than one business cycle, and in this case we're going to talk about a contract that is A, profitable, and B, that is not qualifying for revenue recognition over time. Revenue is recognized at the end of the project. We want to go over a couple of things before we start over here in the accounts. Of course, you know what cash and accounts receivable are. Revenue for long-term contracts, of course, revenue account. Cost of construction, expense account. These two, construction in progress, is an asset account, and billings on construction on the construction contract is a contra asset account. And the reason we do this is because think of a regular product that you manufacture and sell, or that you purchase and sell. You record the accounts receivable and the sales revenue at the same time as you record cost of goods sold and the credit to inventory. You have an asset called inventory on your books, and it's a physical asset, and you relinquish that asset and obtain an asset that is a financial asset, the accounts receivable. In a long-term contract, we're creating an asset, and we're billing for it, so we have accounts receivable, but we haven't relinquished the asset yet. And so we have the physical asset and the financial asset, the receivable, on the books at the same time, unless we do what we do here, which is whenever we bill for an asset that we're not going to record revenue for at the moment, we credit the contra asset billings on construction contract, and that reduces the physical asset by the amount that we are billing. So the physical asset is reduced. The net amount of the physical asset is reduced by the amount of the financial asset. Okay, so let's dive into this little problem here. Construction company entered into a contract to build a road for $10 million. The road was completed in 2029, so 27, 28, 29, 3 years, and it does not qualify for revenue recognition. Here, over time anyway, here is the little chart of information. We have cost incurred in the first year, $2,400,000, $3,600,000 in the second year, and $2,200,000 in the third year, a total of $8,200,000. It's a $10 million contract, so we're profitable all the way along. Estimated cost to complete in the first year is $5,600,000. So if you think about it, at this point, at the end of year 2027, we estimate $8 million to complete the project. I mean, for total cost for the project. At the end of the second year, we estimate $8 million to complete the project. $2,400,000 from the prior year, $3,600,000 for the current year, plus $2 million to complete. And at the end of the last year, we don't have to estimate it. We instead of taking $2 million to complete it, we ended up spending $2,200,000, and so we have a total cost of $8,200,000. Billings during the year: we billed the first year $2 million, we billed the second year $4 million, we billed the last year $4 million, so a total of $10 million. Cash collected during the year: we collected $1,800,000 the first year, $3,600,000 the second year, and $4,600,000 the third year. So our revenue and cash collections matched up. I want to show a couple more columns here, or rows. The revenue that we recognize each year is zero until the last year, and the gross profit is also zero, of course, because we have no revenue. Gross profit is the difference between the contract amount, the contract $10 million, and the $8.2 million that we spent. But in 2027, we still need to record our costs and the billings. So the first thing we do is record the amount of the project, the cost that we spent, $2,400,000. So I'll get in a minute. $2,400,000 in the cost of construction project, and I'm going to just put this in cash, materials, other things that we spent on the project. I'm just going to stick it in cash for the time being. That's recording our cost. It goes into those two accounts. This is a hodgepodge of accounts, but we're just going to stick it in cash to make it easy on ourselves. The next year, and not in the next year, but the same year, we also need to record the billings. We billed the client $2 million. So we're going to debit accounts receivable. $2 million. We're also going to credit the contra asset billings on construction project. $2 million. And then we're going to also collect our money here. So we collected $1,800,000 for for cash, and then we credit the accounts receivable. So now you can see the construction asset is reduced by the amount of the billings. The net construction asset is reduced by the amount of the billings, but there's no revenue. We're not recognizing any revenue. Let's go to the second year. In the second year, we're going to do a similar thing. In this case, we're going to have cost incurred during the year, $3,600,000. I just realized I had the wrong account name up here, and so I've corrected that. I've also put in the 2028 journal entries, $3,600,000 for construction in progress and cash and materials, etc. That hodgepodge of accounts. Billings, $4 million. So debit accounts receivable, credit billings on construction project. And for the collections, debit cash, credit accounts receivable. So let's go ahead and put these in what we will call our ledger. Seems like I'm losing that there. It was a debit to construction in progress and a credit to cash, materials, etc. The hodgepodge of things over there. Hang on a second. Then we have the accounts receivable, $4 million, and billings on account. Again, the contra asset account. And then we collect the cash. Let's see if I got that. Yep, it's interesting, we collected the same amount. So we collected cash. And credit accounts receivable. Oops, and I think that gets us all in balance. We happen to have the costs and collections of the same amount. Now let's go to 2029, and I'll go ahead and put those journal entries up for us. Okay, so the construction and progress account gets a $2,200,000 debit. Cash, materials, etc. gets a $2,200,000 credit. Accounts receivable, we're going to bill them $4 million, so debit accounts receivable, credit billings on contract. So let's do those. $2,200,000 to construction in progress. And this came from all kinds of different expenditures. We're just going to stick it in cash right now. We have a $4 million billing. In 229. Credit to the contra asset account. And then we collect cash of $4,600,000. Now here at the end, you notice I had this no journal entry required. I have the same thing up here. I just didn't show it to you. But this is what the revenue entry would be. So there's no revenue in the first 2 years, no profit at all. So the last year, though, we're going to enter our revenue. So we're going to take the cost of construction, that expense account. We're going to debit it for all the amount that we've billed, that we've incurred. So let's look at our balance here. $8,200,000. So we're going to debit our cost of construction for the $8,200,000. Now I'm not going to put this one first. I'm going to leave this one till last. Let's do a debit to the cost of construction for $8,200,000. We're going to credit revenue from long-term contracts for $10 million. That's how much revenue we got. If you look at the billings and the accounts receivable, let's go ahead and do that one too. So we're going to go ahead and credit our revenue for the whole amount. And so we know those two numbers. Those two numbers are easy. We're going to go ahead and debit the construction in progress, the asset account, for the difference between the two, and that's going to be our gross profit. That's the number. So we just go ahead and 2029 debit this account for $1,800,000. And as you see, that leaves us a balance in the construction account of $10 million. $10 million in the asset account, which we'll get rid of when we close our books, and then the revenue of $10 million. Cost of construction and revenue equal the amount that we're putting in here, and that becomes our gross profit. I'm not going to get a balance on these two accounts, but let's just get a balance. I don't need a balance on the cash account because it represents a lot of things. Accounts receivable, let's just see if we have a zero balance. I think we do. Yeah. So at the end of the period, we have no balance in accounts receivable. All right, and that's how we do a profitable long-term contract that does not qualify for revenue recognition over the course of the contract.